You've built probably around $300,000, 650,000 plus. You survived 2008 when your portfolio dropped 40%. You held through 2020 when the world shut down. You've done everything right. You have the discipline, the savings, the experience. But here's what nobody tells you. Surviving crashes isn't enough. The people who stay rich forever don't just survive volatility. They profit from it. Charlie Munger understood something about wealth that most people, including most wealthy people, completely miss. He understood that the goal isn't to protect your money from chaos. The goal is to build a system where chaos makes you stronger, where market crashes, economic disasters, and unexpected crises don't just fail to destroy you, they actually improve your position. You're 58 with $520,000, or 62 with $740,000, or 68 with $890,000. You spent decades building this, and you're terrified that one bad sequence of events will destroy it all. That fear is rational. But the strategy most people use to address that fear, extreme conservatism, cash hoarding, risk avoidance, is exactly what guarantees eventual failure. Before we get into this, do me a favor. Drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country. Just let me know. This is where people with $500,000 to $1 million make their most dangerous mistake. They think wealth preservation means avoiding risk. They think staying rich means playing defense. But that's fragile thinking, and fragile systems break. Here's what's really happening. You're optimizing for the wrong outcome. You're trying to avoid losses. But in a world of inflation, changing tax laws, healthcare cost explosions, and 30-year retirement timelines, avoiding losses guarantees you lose. You don't need a system that survives chaos. You need a system that gets stronger from it. The people who stay rich forever understand anti-fragility. The people who go broke slowly, despite doing everything right, are optimizing for fragility without knowing it. And the difference between these two groups isn't intelligence or starting capital. It's understanding that defense alone is a losing strategy in a dynamic system. You check your portfolio every week, sometimes every day. When the market drops 5%, your stomach drops with it. When it's up 10% for the year, you feel relief but not security. You're on defense, always, and it's exhausting. Here's what you think is happening. You're being prudent, responsible. You're protecting what took 30 years to build. You watch the news. You rebalance quarterly. You have a conservative allocation appropriate for your age. 60% stocks, 40% bonds. Maybe 50-50 if you're really cautious. You're following the rules. But here's what's actually happening. You've built a fragile system. And fragile systems don't just break under extreme stress. They slowly deteriorate under normal conditions while appearing stable right up until they fail catastrophically. Let me show you what this looks like. You're 62 with $680,000. You're 3 years from retirement. The market drops 25% over 6 months. Your $680,000 becomes $10,000. You panic. Not immediately. You've been through crashes before, but as weeks turn to months and the portfolio stays down, fear takes over. You sell 40% of your stocks and move to cash. I can't risk losing more, you tell yourself. I'm too close to retirement. The market recovers over the next year. Your remaining stocks participate, but you locked in losses on the 40% you sold. Worse, you now have $200,000 sitting in cash earning nothing while inflation runs at 3.4%. You feel safer, but you just made yourself objectively poorer and more fragile. Here's why this matters more than you think. That decision, selling during a crash out of fear, wasn't a one-time mistake. It was a symptom. It revealed that your entire system is built on fragility. You're not set up to handle volatility. You're set up to be destroyed by your reaction to volatility. Most people don't realize what's happening beneath the surface. They think they have a portfolio strategy. What they actually have is an emotional survival mechanism disguised as a plan. And emotional survival mechanisms fail precisely when you need them most, during chaos. You did the 401k match, maxed your IRA, bought the house, raised the kids, somehow built $680,000 despite life happening, and now you're optimizing for not losing it. That seems rational. But that's not even the worst part. The worst part is this. While you're playing defense, inflation is playing offense. Healthcare costs are compounding at 6% annually. Your actual living expenses are rising faster than your conservative portfolio can keep up with. You're not standing still. You're losing ground. Slowly, invisibly. Until one day at 78, you realize the $680,000 that felt sufficient at 62 now barely covers what you need. You've built a system that survives normal conditions but fails in exactly the scenarios it was designed for. That's fragility. Munger studied this for decades. He understood that most people confuse robustness with anti-fragility. They're not the same thing, not even close. Robustness means you can withstand shocks. A robust portfolio doesn't collapse when the market drops 30%. That sounds good. But robustness has a ceiling. A robust system can take hits without breaking. But it doesn't improve from the hits. It just survives. Anti-fragility is different. An anti-fragile system gets stronger from stress. Not despite stress, from it. Chaos, volatility, and unexpected events don't just fail to harm it. They actively improve its position. Here's the math nobody shows you. Your $600,000 portfolio in a robust 60-40 allocation might survive a crash, but it doesn't benefit from the recovery. You're optimized to not lose, which means you're also optimized to not gain during the chaotic periods when the biggest gains happen. Let me make this visible with actual numbers. 2 retirees, both 63 years old, both starting with $600,000 in 2007, right before the 2008 financial crisis. Person A has a robust system, 55% stocks, 45% bonds, $50,000 in cash for emergencies. Conservative, prudent. When the market crashes in 2008-2009, their stocks drop 50%, bonds stay stable. Portfolio goes from $600,000 to $435,000. They panic. They rebalance out of stocks at the worst possible time, going to 30% stocks, 70% bonds, and cash. They protect what's left. Person B has an anti-fragile system, 70% stocks, 20% bonds, but, and this is critical, they have 3 years of living expenses in cash, not as an emergency fund, as an operational buffer. When the market crashes, their stocks get hammered, just like Person A. Portfolio dropped to $450,000. But they don't panic. Why? Because they're not selling. They're living off the cash buffer while the stocks are down. They're not just holding. They're rebalancing into stocks during the crash because they're cheaper. Fast forward to 2015. Person A has roughly $520,000. The conservative rebalancing, the fear-based cash position, the reduced stock exposure, it all compounded into underperformance. They're nervous, checking their account constantly, wondering if they'll make it to 80. Person B has roughly $780,000. The anti-fragile system didn't just survive the chaos. It profited from it. They rebalanced into stocks at the bottom. They never sold out of fear because they never needed to. The cash buffer gave them time. The crash made them wealthier. Now here's where it gets interesting. This isn't hindsight. This isn't market timing. This is system design. Person B's system was engineered to profit from volatility. Person A's system was engineered to survive it. One grows from chaos. One slowly dies from it. The psychological mechanism is this. Humans judge security by account balance, not by system resilience. That's why $600,000 in a fragile system feels safe right up until it breaks. And $600,000 in an anti-fragile system feels risky, even though it's objectively more secure. You see your account balance. You don't see your vulnerability to sequence risk. You don't see how your conservative allocation is slowly losing to inflation. You don't see that your cash position is an anchor, not a life raft. You feel safe because nothing has broken yet. But fragile things don't send warnings before they shatter. The 4% rule was built for 30-year retirements in a different economic environment. You're retiring in an era of low bond yields, high valuations, uncertain inflation, and 35-year retirement timelines. The old robust strategies aren't just outdated. They're dangerous, and most people won't realize it until the damage is irreversible. Here's the truth that contradicts everything the financial industry tells you. Safety isn't found in avoiding volatility. Safety is found in being positioned to profit from it. The wealth-building strategies that got you to $650,000, consistent contributions, broad diversification, buy and hold, those still matter. But the wealth preservation strategies most people adopt in their 50s and 60s are exactly backward. They make you more vulnerable, not less. People think the older you get, the less risk you should take. That's fragile thinking. The older you get, the more you need anti-fragile positioning, because you have less time to recover from being wrong. Let me show you the paradox. At 45, with $300,000 and 20 years until retirement, you can afford to play conservative. You have time. A market crash hurts, but you recover. At 60, with $700,000 and retiring in 2 years, you cannot afford fragility. A crash combined with immediate withdrawals destroys you through sequence risk. So what do most people do? They get more conservative precisely when they need to be more anti-fragile. Here's something that surprised me when I really studied successful retirees. The ones who never ran out of money weren't the ones with the biggest portfolios. They weren't the most conservative. They were the ones who built systems that improved during chaos. What does that actually mean? It means having enough liquid cash that you never have to sell stocks during a crash. It means maintaining equity exposure throughout retirement, because inflation is a 30-year problem, not a 5-year problem. It means understanding that the years when the market drops 40% are exactly the years when rebalancing into stocks sets you up for the next decade. The data shows something nobody expects. Retirees who maintained 60-70% stock allocations throughout retirement had higher success rates than those who went to 30-40% stocks. Not because stocks always go up, but because the alternative, bonds and cash in a low-rate, high-inflation environment, guarantees slow failure. You might be thinking, but what about 2008? What about people who retired right before that crash? Let me tell you why that doesn't work the way you think. The retirees who failed in 2008 weren't killed by the crash. They were killed by the reaction to it. They sold. They locked in losses. They never recovered because they turned temporary market losses into permanent capital losses. The retirees who succeeded had anti-fragile systems. They had cash buffers. They didn't need to sell. They let the stocks recover. Some even rebalanced into stocks during the crash. By 2013, they were fine. By 2020, they were thriving. Same crash, different system, different outcome. That's the trap. The financial industry tells you to reduce risk as you age. What they mean is reduce volatility. But volatility isn't risk. Running out of money is risk. Inflation destroying your purchasing power is risk. Having to sell stocks at the bottom because you don't have a cash buffer is risk. Volatility is just the price you pay for growth. And in a 30-year retirement, you need growth. Munger understood this at a molecular level. He said successful investing isn't about avoiding mistakes. It's about positioning yourself so that mistakes don't kill you and opportunities make you rich. That's anti-fragility. You're not trying to predict the future. You're building a system that works across multiple futures. So, what does an anti-fragile retirement system actually look like? Not theory, practical, something you can build. First principle, the cash buffer is your foundation, not an emergency fund, an operational buffer. This is how you survive sequence risk. This is how you avoid panic selling during crashes. For pre-retirees, you're 55 to 65, still working, planning retirement in 5 to 10 years. Here's what matters. Your final decade before retirement is about building the cash buffer and managing sequence risk. Not about maximizing growth. Let's say you're 58 with $650,000 and planning to retire at 65. You need $60,000 per year to live. Here's the anti-fragile structure. Build $180,000 in cash and short-term bonds. 3 years of expenses. That means your remaining $470,000 stays invested. 60-70% stocks, 30-40% intermediate bonds. When you retire at 65, you live off the $180,000 cash buffer. You don't touch the stocks. For 3 full years, the market can do whatever it wants. Crash 40%, you're fine. You're not selling. By year 3, either the stocks recovered or they didn't. If they did, you replenish the cash buffer from gains. If they didn't, you reassess. But you bought yourself 3 years of time. That's anti-fragility. For recent retirees, you're 60 to 70, just retired or about to retire, your withdrawal strategy is everything. The 4% rule is outdated and dangerous. Here's why. It assumes constant withdrawals regardless of market conditions. That's fragile. Anti-fragile withdrawals flex. In years when your portfolio is up 20%, you withdraw 5%. You enjoy life. You do the things you saved for. In years when your portfolio is down 20%, you withdraw 3%. You tighten the belt temporarily. You don't starve, but you don't accelerate depletion during the worst possible time. This requires behavioral flexibility most people don't have. You need to be able to spend $70,000 in good years and $50,000 in bad years without feeling like you failed. That psychological flexibility is more valuable than an extra $100,000 in your portfolio. Social Security timing is another anti-fragility lever. Most people think about this wrong. They ask, when should I claim to maximize lifetime benefits? That's not the right question. The right question is, what maximizes my system's resilience? If you have $400,000 at age 62 and you claim Social Security immediately, you get roughly $24,000 per year. If you delay until 67, you get roughly $34,000 per year. That's a $10,000 annual difference for the rest of your life. But it requires living off your portfolio for 5 years while Social Security grows. Here's the anti-fragile play. Use your portfolio to bridge from 62 to 67. Let Social Security grow to the higher benefit. Why? Because Social Security is inflation-adjusted guaranteed income. Every dollar of Social Security you maximize reduces the pressure on your portfolio forever. That's a permanent increase in system resilience. For active retirees, you're 65 to 80, already retired, managing existing wealth. Your challenge is different. You're not accumulating. You're not in early sequence risk years. But you're facing the long tail. And the long tail is where inflation destroys fragile systems. If you're 68 with $800,000 and spending $50,000 per year, here's what matters. You need growth. Not for greed, for survival. At 3% inflation, your $50,000 spending becomes $67,000 by age 78 and $90,000 by age 88. If your portfolio doesn't grow, you're toast. This is why going to 30% stocks at 70 is fragile. You're optimizing for short-term volatility reduction while guaranteeing long-term failure. The anti-fragile allocation at 70 is still 50 to 60% stocks. You need equity exposure for the 20-year timeline you're likely to live. The decision framework for all of this. Stop asking, is this safe? Start asking, is this anti-fragile? Does this position benefit from volatility or suffer from it? Does this system get stronger under stress or weaker? Does this strategy work in multiple scenarios or just one? When you're deciding whether to delay Social Security, the question isn't, will I live long enough to break even? The question is, does this increase my system's resilience to inflation and longevity risk? When you're deciding on portfolio allocation, the question isn't, will stocks crash? The question is, if stocks crash, does my system survive and profit from the recovery? That shift in framework changes everything. Let me show you what anti-fragility looks like over 25 years. Two people, both 62 years old in 2008, both with $700,000 saved, both retiring that year. Worst possible timing, retiring into the financial crisis. Person A thinks defensively. They go to 40% stocks, 60% bonds and cash. They want safety. They withdraw $35,000 per year, 5% initially, planning to reduce as the portfolio shrinks. When the market crashes in 2008-2009, their portfolio drops to $580,000. They're terrified. They go even more conservative, 25% stocks, 75% bonds and cash. They feel safer. Person B thinks anti-fragile. They have 65% stocks, 25% bonds, but critical $105,000 in cash, 3 years of expenses at $35,000 a year. When the market crashes, they don't touch the stocks. They live off the cash. The stock portion of their portfolio crashes from $455,000 to $250,000. Looks terrible, but they're not selling. They're waiting. Year 1-3, ages 62-65. Person A has $545,000. Their conservative allocation limited losses, but also limited recovery. They're anxious. Person B has $560,000. They depleted the cash buffer, but held all stocks through the recovery. The stocks bounced back. They're calm because the system worked as designed. Year 5, age 67. Person A has $490,000. The ultra-conservative allocation meant they missed most of the 2009-2013 bull market. Withdrawals plus minimal growth are slowly eroding the base. They're worried. Person B has $680,000. They replenished the cash buffer in 2011 from stock gains. They're still 65% stocks. They're ahead of where they started despite retiring into a crash. Year 10, age 72. Person A has $380,000. They've had to cut spending to $28,000 per year. Social Security helps, but they feel poor. They're constantly stressed about money. The fragile system is slowly failing exactly as designed. Person B has $820,000. They increased spending to $42,000 per year because the system can handle it. They've traveled. They've helped their kids. They've lived. The anti-fragile system grew through chaos. Year 15, age 77. Person A has $280,000. They're genuinely worried about running out. Every expense feels like a threat. They're not living. they're surviving. The fragile system is in its death spiral. Person B has $910,000. They weathered the 2020 COVID crash the same way they weathered 2008. Cash buffer. No panic selling. Patience. They're spending $48,000 per year and still growing the portfolio. Year 20, age 82. Person A has $180,000. They're cutting spending to $22,000 per year plus Social Security. They're stressed constantly. They can't help their grandchildren. They can't handle unexpected medical expenses. They regret not enjoying their 60s when they were healthy because they were too afraid to spend. Person B has $950,000. They've spent more, lived better, helped family, and still have more wealth than they started with. The anti-fragile system worked exactly as designed. Year 25, age 87. Person A has $90,000 left. They're terrified. They're rationing everything. The fragile system failed slowly, then suddenly. Person B has $880,000 after higher spending and medical costs in their 80s. They've lived 25 years of retirement without ever feeling poor. They'll leave significant wealth to their children. The anti-fragile system never broke. Same starting point, same market returns over 25 years. Both survived the 2008 crash, the 2020 crash, inflation, everything. Different thinking, different system design, and $790,000 difference in outcomes. More importantly, 25 years of completely different life quality. The decisions made at 62 determined the reality at 87. The fragile system optimized for short-term comfort, feeling safe by avoiding volatility, which guaranteed long-term failure. The anti-fragile system accepted short-term volatility as the price for long-term resilience. One approach feels good until it doesn't. One approach feels scary until you realize it works. Now, I know what some of you are thinking. Charlie, this sounds great in hindsight, but what if person B retired in 2000 instead of 2008? What if they hit the dot-com crash and the 2008 crash and the 2020 crash? Would the anti-fragile system still work? Let me show you why this question reveals you're still thinking in fragile terms. The anti-fragile system doesn't depend on getting lucky with timing. It works precisely because it's designed for multiple catastrophes. Person B's system had 3 full years of cash. That's not a buffer for one crash. That's a buffer for prolonged chaos. Here's what actually happens if you retire into serial disasters. The first crash hits. You live off cash year 1. Market stays down. You live off cash year 2. Still not recovered. You live off cash year 3. By year 4, either the market recovered, it always has, or you reassess and make adjustments from a position of not having sold at the bottom. Compare that to Person A's fragile system. First crash hits. They have 1 year of cash. By year 2, they're forced to sell stocks at depressed prices. They lock in losses. They never recover. The second crash finishes them off. The anti-fragile system survives serial catastrophes because it gives you time. Time is the ultimate hedge against chaos. Person B's cash buffer bought 3 years of time. Person A's limited buffer meant they were always 1 bad year away from forced selling. This is why the size of your cash buffer matters more than your portfolio size. Person B would rather have $600K with a $100K cash buffer than $700K with $30K cash buffer. The first is anti-fragile. The second is fragile pretending to be safe because the number is bigger. So when you're evaluating your own system, don't ask, do I have enough money? Ask, do I have enough time? Because time, the ability to wait out chaos without forced selling, is what separates anti-fragility from fragility. Here's what this means for you right now. You're 58 with $520,000, or 64 with $680,000, or $70 with $750,000. The question isn't whether you have enough. The question is whether your system is anti-fragile. Because if it's fragile, no amount is enough. And if it's anti-fragile, modest amounts can last forever. The hardest part of building an anti-fragile system isn't the math. It's not the allocation. It's not the cash buffer. It's the psychological shift from seeing volatility as threat to seeing it as opportunity. For 40 years, volatility was your enemy. Market crashes meant your 401k balance dropped. You couldn't do anything about it except hold on and hope for recovery. Your job was to earn money and save it. The portfolio's job was to grow. Chaos disrupted that plan. Now, in retirement or approaching it, the rules completely changed. But your brain hasn't caught up. You still see market crashes as threats. You still feel sick when your portfolio drops 15% in a month. You still measure success by account balance, not by system resilience. Here's the identity shift required. You're no longer an accumulator hoping volatility doesn't destroy your plan. You're a portfolio manager, engineering a system that profits from volatility. That's a completely different role. Different skills, different metrics, different emotional relationship with chaos. From accumulation to anti-fragile distribution. For 40 years, you saved. Every dollar that went into the account felt like progress. Every market drop felt like setback. Now, you need to spend. And more than that, you need to build a system where market drops create opportunities. Your brain hates this. Spending feels like failure. Maintaining high equity exposure in retirement feels dangerous. Building a cash buffer feels like dead money. But that discomfort is the price of anti-fragility. From risk avoidance to risk management. You spent decades trying to avoid mistakes. Max out the 401k match. Diversify. Don't panic sell. Don't try to time the market. Those were good rules for accumulation. But anti-fragility requires different thinking. You're not avoiding risk. You're structuring your system so risk works for you. That means accepting volatility as inevitable and positioning to profit from it. From fear to calibrated confidence. Most retirees are terrified they'll run out of money. So they underspend, overconserve, and die with millions unspent. That's not success. That's fear-based failure. The psychological unlock is understanding that anti-fragile systems generate confidence through engineering, not through size. Person B in my scenario had more confidence with $700,000 in an anti-fragile system than person A had with the same amount in a fragile one. The confidence came from the system, not the number. Here's why people resist this shift. It requires accepting that safety is an illusion. There is no allocation that guarantees you'll be fine. There is no amount of money that removes all risk. The fragile approach, go conservative, hold cash, avoid volatility, feels safe because it promises certainty. But that certainty is fake. You're certain in the short term and vulnerable in the long term. The anti-fragile approach feels uncertain because you're accepting volatility as permanent. Your portfolio will crash multiple times in retirement. That's not a maybe. That's a guarantee. Anti-fragility doesn't prevent crashes. It makes them profitable. But accepting that requires psychological maturity most people don't have. Once you make this shift, everything changes. You stop checking your portfolio daily. Because daily fluctuations don't matter in an anti-fragile system. You stop feeling guilty about spending in good years because flexible spending is part of the design. You stop comparing yourself to people with bigger portfolios because you understand system resilience matters more than size. And you start thinking in scenarios instead of predictions. You don't ask, will the market crash? You ask, what happens to my system if the market crashes? You don't ask, will inflation stay low? You ask, does my system handle high inflation? You're not predicting. You're preparing for multiple futures simultaneously. That's the ultimate psychological shift. You're not trying to be right about the future. You're building a system that works across multiple futures. That's anti-fragility. And once you get it, once you really understand it, you can't unsee it. Remember what I said at the beginning. You've built $650,000. You survived 2008, 2020, everything. You've done everything right. But surviving crashes isn't enough. The people who stay rich forever don't just survive volatility. They profit from it. Here's how to audit your current system for fragility, not theory. Actual steps you do this week. Step 1. Calculate your time buffer. How many months can you live off cash and short-term bonds without touching stocks? If it's less than 18 months, your system is fragile. You're one crash away from forced selling. Build to 24, 36 months minimum before you retire. Specific action. Add up your checking, savings, money market, and bonds maturing within 2 years. Divide by your monthly spending. That's your time buffer in months. Write that number down. Step 2. Assess your withdrawal flexibility. Can you reduce spending by 30% in a bad year without feeling like your life ended? If you're locked into $80,000 annual spending no matter what, your system is fragile. Anti-fragile systems have flexible spending. Specific action. List your annual expenses. Mark which are truly non-negotiable. Housing, healthcare, food basics. Mark which are discretionary. Travel, dining, entertainment, gifts. If discretionary is less than 25% of total, you have no flexibility. That's fragile. Step 3. Check your equity exposure. If you're under 50% stocks in your 60s or 70s, you're optimizing for short-term comfort at the expense of long-term survival. That's fragile. You need 50, 70% stocks to beat inflation over 25, 30 years. Specific action. Pull your latest portfolio statement. Calculate actual stock percentage. If it's below 50% and you're healthy with a 20-plus year timeline, you're underexposed. You're guaranteeing slow failure to inflation. Step 4. Evaluate Social Security timing. If you're planning to claim at 62 because the system might collapse, you're making a fragile decision based on fear. Delaying to 67 or 70 increases lifetime benefits by 40-75%. That's permanent inflation-adjusted income. Specific action. Go to ssa.gov. Get your benefit estimate at 62, 67, and 70. Calculate the lifetime difference assuming you live to 87. Is claiming early worth giving up $200,000 plus in lifetime benefits? That's the real math. Step 5. Stress test your system. What happens if the market crashes 40% in your first year of retirement? Does your system survive? Does it profit from the recovery? Or does it force you into panic selling? Specific action. Take your current portfolio. Reduce stocks by 40%. Add back expected growth from bonds. Subtract your first year withdrawal. Can you survive 3 years like this without selling more stocks? If no, your system is fragile. If you fail 3 or more of these tests, your system is fragile, not broken, not doomed, but fragile, which means you have work to do before you retire, or you need to restructure immediately if you're already retired. The good news, fragile systems can become anti-fragile. It's not about having more money, it's about restructuring what you have. Build the time buffer. maintain equity exposure, create spending flexibility, optimize Social Security, test the system. Do this work now, because the time to build anti-fragility is before chaos, not during it. Now, you know the truth. The question isn't whether $650,000 is enough. The question is whether your system is anti-fragile, because fragile systems fail slowly, then suddenly. And no amount of money saves a fragile system. But anti-fragile systems get stronger through chaos. And modest amounts in anti-fragile systems outlast massive amounts in fragile ones. So here's what happens next. Most people will hear this and do nothing. They'll keep their conservative allocation because it feels safe. They'll hold too much cash because it feels prudent. They'll panic sell during the next crash because they don't have buffer systems. They'll optimize for short-term comfort and guarantee long-term failure, and they'll realize too late, at 78 or 82, that they engineered their own slow destruction. A small group will hear this and restructure. They'll build cash buffers. They'll maintain equity exposure. They'll engineer systems that profit from volatility instead of suffering from it. They'll accept short-term chaos as the price for long-term resilience. They'll retire earlier, live better, and die wealthier despite having less to start with. The difference isn't intelligence. It's not starting capital. It's not luck. It's understanding that wealth in retirement doesn't belong to the people with the biggest portfolios. It belongs to the people with the most resilient systems. It belongs to people who understand anti-fragility, who build for multiple futures instead of betting on one, who accept that safety isn't found in avoiding volatility, but in being positioned to profit from it. Anti-fragility works like this. Fragile systems optimize for comfort and guarantee failure. Anti-fragile systems accept discomfort and guarantee resilience. The people who understand this stay rich forever. The people who don't slowly go broke despite doing everything right. That's how wealth in chaos actually works. Your system determines your outcome. Engineer accordingly. Now, if you want more brutal honesty about building wealth and achieving financial independence, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth.